Welcome to Breaking News to Trading Moves. We're jumping right into a corporate move that has a lot of people in the market talking. We're seeing analysts and day traders, really everyone, trying to map out what the potential capital flows are going to be. Our focus today is on Trump Media and Technology Group, specifically their recent decision to launch a new set of thematic ETFs, exchange-traded funds, and the movements that we're already starting to see in some related sectors.
Right, and it's a bit of an unusual situation. You have a media company that's now branching out into asset management.
Exactly. And it's creating these very clear market signals for traders who know how to read the narrative.
And that's really where we need to start. Our goal here is very specific, and it's, very action-oriented for you listening. We need to break down this event, detail the immediate reaction to the company itself, Trump Media, ticker DJT.
Okay.
But then, and this is the crucial part, we need to look past the company and identify who the perceived beneficiaries are, the winners, so to speak, and which stocks might face some headwinds, the losers.
And this is all based on observed investment flows and the very, very specific themes these new products are introducing.
Exactly. We're looking at how a political or social narrative gets translated directly into tradable movement in established stocks.
So the core headline that kicked all of this off was this. Trump Media, that's ticker DJJT, announced they're launching 5 new America First branded ETFs. This is under their new initiative called Truth.Fi. And they did it in collaboration with Yorkville America Equities, with a plan to list them on the New York Stock Exchange.
It's a very clear, very deliberate expansion beyond their core platform, Truth Social.
It is.
And it's a strategic move that immediately makes traders ask 2 big questions.
Which are?
1, what does this mean for the company's actual focus? And 2, where is all this narrative-driven money actually going to end up?
All right, let's start with the products. The information we have suggests this isn't just one big generic fund. It seems like a very targeted strategy.
It is.
They're starting with 5 thematic ETFs. Why 5? And what's with these specific themes?
The segmentation is really the key here. It allows them to target different pools of capital.
So you mean an investor could like one theme but not another?
Exactly. If you're an investor who believes in the defense narrative, but maybe you're a little skeptical about the energy story, this segmented structure gives you a way to act on that specific conviction.
Right. It lets you pick your lane.
And that's a crucial part of modern thematic investing. Specificity is what creates interest.
So tell us more about those initial themes. What are they?
Well, they're highly specific, and they really tap into current geopolitical and domestic topics that resonate with a particular kind of investor.
Okay.
So first, there's a clear focus on U.S. defense. This aligns with, national security, global instability, all those geopolitical risk concerns.
Makes sense. What's the second one?
The second is a theme built around U.S. energy security. This is a direct play on the narratives around domestic production, infrastructure, and just general energy independence.
And the third?
The third is maybe the most granular of the bunch. It's focused on red state real estate.
Red state real estate. So that's a very specific geographic and demographic play.
It is. It's targeting those fast-growing regions in the U.S., especially in the Sun Belt.
And we know this is just the beginning, right? The company has said they plan to expand more later.
That's right. They've specifically mentioned that more products are on the way, including digital asset products.
So that signals a much bigger goal. They're aiming to build out a full financial technology or Fintech footprint.
That is the right way to look at this. Their ambition is clearly to become this diversified entity, expanding into financial services and investment products.
Yeah.
But the market's immediate reaction to the company itself, to DJT, suggests some serious hesitation from investors about this new direction.
So what happened when the news came out? What did the stock price for Trump Media do?
The immediate result for the company was negative pressure. The stock fell about 3% right after the ETF launch was announced.
Okay, a 3% drop. It's not a total collapse, but it's telling, isn't it? Usually, news about expansion is met with at least some enthusiasm.
It is very telling.
Wait a minute, though. This is a high-profile, narrative-driven stock. The whole brand is built on making a splash, on volatility. Wouldn't an announcement like this usually cause an initial spike?
You'd think so.
So where did that enthusiasm go? Why the negative reaction?
That's the fundamental question for anyone trading these kinds of story stocks. The negative move seems to be attributed to investors questioning the company's ability to actually execute on this new, much broader strategy.
So execution risk.
Precisely. You have a company with an existing core product, Truth Social, and it suddenly announces a move into a completely new, highly regulated, and incredibly competitive field like asset management.
And traders start pricing in the risk that they might not be able to pull it off.
Exactly. Are they worried the company will just fail at this new venture? Yes. The focus is widening so dramatically beyond their media platform.
It's like a small, really good coffee shop suddenly announcing it's also going to start a national chain of car washes.
That's a perfect analogy. Investors worry that the core business is going to suffer because management's distracted, capital is spread thin, and they just don't have the expertise for the new thing.
You call that strategy dilution.
Exactly. Traders often penalize companies when their strategic focus gets too blurry, especially if the new ventures are so far from their original expertise. And fintech is a long way from social media.
So the market is asking a simple question. Can DJT succeed as a social media platform, where they're still fighting for market share and profitability, and at the same time launch and manage 5 complex financial products?
And that initial drop suggests the market's answer is, we have our doubts.
The downward move is reflecting that uncertainty.
Yes. And it's compounded by the fact that the company is still reporting ongoing losses in its core business. So that tension between the big ambition and the immediate risk is what defined that initial 3% drop.
Okay, now let's get to the core of this. The story is bigger than just what happened to DJT's stock. We need to explain why this event matters for traders in general, even if they never plan to touch DJT's stock itself.
Right.
This is about the influence of the themes, not just the size of the funds.
The relevance here comes from the power of a clear, well-branded narrative in today's trading environment. We call this the theme flow catalyst.
The theme flow catalyst.
Even if the assets under management, the AUM, for these new ETFs starts out really small, maybe just a few $1,000,000, the public announcement itself acts like a huge magnet for attention.
Okay, break that down for me. How does a headline about a tiny ETF influence a massive company like ExxonMobil, ticker XOM, or Lockheed Martin, LMT? What are the mechanics?
It works in about 3 steps. First, the news validates the theme. It tells the market that defense security or energy security is a real tradable investment thesis.
So it puts a stamp of approval on the idea.
Exactly. Second, it publicizes the potential stocks in that theme. Even if we don't know the exact holdings, the themes give you a pretty clear shopping list of companies that would logically be included.
And
Third, it directs flows at the margin. A retail investor reads the headline. They might not go buy the small, brand new ETF. Instead, they might just look up the biggest, most established company in that theme, like Lockheed Martin, and buy shares of LMT directly.
So the ETF itself might only buy, say, 1,000 shares of Lockheed to get started.
Right.
But the collective attention from the headline could drive 10 times that volume, 10,000 shares or more, into the stock, completely independent of the ETF's own actions.
You've got it. It's all about the framing and the narrative. The headlines give people a reason to invest in these ideas, and it flows into these big blue chip companies that suddenly see a little extra demand from individuals acting on the story.
Okay, let's move to the second point, this idea of the conglomerate drift signal, looking back at DJT itself.
Yeah.
You said this shows the company is trying to become a multi-vertical platform.
Media, fintech, maybe other things down the line.
And sophisticated traders are skeptical of that.
Very. Like we said, the market responds to this drift by pricing in uncertainty. They apply what's known as a conglomerate discount.
A conglomerate discount. Because they'd rather have a company that's really good at one thing.
Investors prefer a focused business where 100% of the value is clear. When a company, especially a volatile one, takes on too many different strategies, social media, asset management, it often ends up being valued at less than the sum of its parts.
Why is that? Why do investors prefer focus over diversification in a single stock?
It really comes down to the efficiency of capital. Traders like a company that dominates one core profitable area. That shows a clear path to creating value.
And when they expand into something like financial products,
which is costly, complex, and highly regulated. It signals to many that management is diverting time and money away from fixing the core social media platform, which is already losing money. It just signals that execution is going to be a challenge across the board.
This tension then, this story stock trying to expand while facing all this skepticism, it must create a very specific trading environment. Let's talk about the volatility setup.
It absolutely does. These story stocks, their value is tied more to sentiment and potential than to, actual cash flow.
So they're very sensitive to news.
Extremely. A headline like this, with a prominent brand and explicit political themes, it just maximizes that condition. It creates the setup for fast momentum moves, often overreactions, which are then sometimes followed by a return to the average.
A mean reversion.
A mean reversion. The news creates the momentum spike, but because nothing fundamentally changed overnight, other traders can position for that snapback to the average price.
It creates a high beta environment around these names.
That's it. The news gives the initial reason for the move, leading to volume and price action that is way out of proportion to the actual money in the new funds. And that's where agile traders can exploit the short-term noise.
Okay, to make this actionable for everyone listening, let's define the specific trade watch signals here. What should you be looking for on your screen?
The main thing is to watch for sudden, sustained volume spikes and price increases in the stocks that are the obvious members of these themes.
Right.
So if you're listening and you see a 2 or 3 day period of really high trading volume in specific defense, energy, or REIT names, this announcement gives you the context for why it's happening.
It's the reason for the volume, suggesting a thematic flow of capital.
Exactly. And the other key thing to watch is what we call the divergence watch.
The divergence watch.
This is essential for managing risk. You need to track if DJT's stock price is falling or staying under pressure.
Okay.
While at the same time, the stocks inside those themed baskets are holding up or gaining strength.
And what does that divergence tell us?
It tells us everything. It suggests the market is willing to buy into the themes. They like the idea of defense and energy exposure, but they do not have confidence in the company that issued the funds.
So they like the product, not the manufacturer.
It's a classic setup. The core asset is seen as shaky, but the thematic assets are gaining favor. That's a key trading insight.
Okay, so now that we understand the catalyst, let's move to the 3 main categories of stocks that could benefit from this. The beneficiaries or the winners.
Right. These are the companies that have strong operational and thematic alignment with the new ETFs.
Let's start with category 1, defense and aerospace primes. Why are these the immediate, obvious choice for a defense-themed fund?
Well, the defense theme is all about stability and reliability. Launching a defense ETF is expected to amplify interest in these well-established large-cap defense names. They are the purest way to play the theme.
They're huge, they're liquid, and their performance is tied to long-term government contracts.
Mm-hmm. They aren't dependent on consumer sentiment or, rapid tech changes. They offer stability and direct, tangible exposure to that national security narrative.
So their stability and liquidity make them a better choice than, say, smaller, higher-growth defense tech firms.
For this kind of broad thematic flow, absolutely, the liquidity is critical. Plus, these primes live off of massive multi-year government budgets, which gives them reliable revenue streams that appeal to thematic investors.
So which specific companies should we be tracking here?
We're looking at the established primes. So that's Lockheed Martin, ticker LMT, Northrop Grumman, ticker NOC, and RTX, ticker RTX.
Okay, let's break those down. Lockheed Martin.
LMT is the titan. They're known for huge platforms like the F-35 fighter program, advanced missile systems. It's a direct bet on continued air and naval power.
And Northrop Grumman.
NOC is deep in strategic systems. Think stealth technology, nuclear deterrence programs.
And RTX.
RTX, which used to be Raytheon, is a leader in aerospace and defense systems, especially missiles, sensors, and intelligence. Their combined size and deep connection to U.S. policy make them the immediate, obvious targets for any defense-themed capital flow.
All right, moving to category 2, the U.S. energy security complex. The theme here is independence. Why does this ETF point directly to these big, established energy players?
The energy security theme, as it's defined politically, is all about domestic independence, maximizing production, and pipeline capacity.
So the ETF framing naturally supports the big liquid energy companies.
It does. It supports the companies that are crucial for maximizing domestic conventional output. They're the cornerstone of the whole U.S. domestic energy supply chain. They represent the current established system.
Yeah, what are the operational reasons for picking these specific companies?
Well, you have to look at the integrated oil and gas majors. They control the whole process from exploration all the way to the gas pump.
Okay, so which names are we talking about?
We're looking at ExxonMobil, that's XOM, and Chevron CVX. Both are global giants with huge domestic operations and refining capacity. They are the definition of stable, liquid exposure to the energy sector.
And there's one more.
Yes, Schlumberger, ticker SLB. They're a major oil field services provider.
So they don't produce the oil, they help the producers get it out of the ground.
Exactly. SLB benefits directly from any increase in domestic drilling or production. They're the indispensable service provider to the majors. All three offer highly liquid exposure, making them easy targets for this thematic flow.
Our final category of beneficiaries is Category 3. This is a very niche area: red state, real estate, and housing-linked REITs. It's not just a sector play, it's geographic.
And that extreme specificity is why the potential effect could be so concentrated. The theme itself is an investment thesis on demographics and regional politics.
So an ETF framed around the fast-growing Sunbelt states like Texas, Florida, North Carolina, it directs attention to a very specific set of real estate assets.
It shines a spotlight on residential, rental, and apartment REITs with large holdings in those specific areas, regions that are seeing rapid population growth, favorable tax policies, and strong job markets.
So we're not talking about generic real estate. We're talking about residential property owners whose portfolios are basically optimized for the Sunbelt boom.
That's it.
So which specific REITs fit that footprint?
The companies cited as potential beneficiaries are dominant players in that exact space. We have Invitation Homes, ticker INVH, American Homes for Rent, ticker AMH, and Mid-America Apartment Communities, ticker MAA.
Let's touch on those. Invitation Homes and American Homes for Rent.
Both INVH and AMH are major players in the single-family rental market. They own thousands of homes across the Sunbelt, making them a pure play on that residential growth story.
And Mid-America Apartment Communities.
MAA focuses heavily on apartment communities throughout the Southeast and Southwest. Their business models, their asset locations are just perfectly aligned with the theme's preference for growth markets in those regions.
So they're a purer play on this theme than a competitor with, say, holdings all over the country.
Correct. Their focus on secondary Sunbelt markets like Tampa, Florida, or Charlotte, North Carolina makes them a much cleaner fit for this specific theme.
Okay, we've mapped out where the thematic capital might go. Now we have to look at the other side of it, the downside risk, the assets that might face selling pressure because this new theme is redirecting capital away from them.
Right. And that idea of rotation is critical. When one narrative gets traction, capital is often pulled from a competing narrative. We have three risk categories here.
Okay, let's start with Category 1, DJT itself and similar high-narrative media and fintech stocks. Why are the issuer, Trump Media, and similar companies like Rumble, ticker RUM, seen as candidates for more downside risk even after that initial drop?
The whole group is just fundamentally volatile and faces serious execution risk. As we said, when DJT expands so rapidly, the market applies a discount for that strategy dilution.
Which leads to a sell the news reaction.
And continued volatility because the market just doesn't have confidence. For both DJT and its peer, Rumble, which is also a narrative-heavy media stock with its own growth challenges, the risk is compounded.
Any distraction or expansion can deflate the fragile sentiment that's holding up their valuations.
Precisely. It keeps them entrenched as these volatility vehicles that are subject to really rapid outflows. The risk isn't just that the new ETF fails, it's the fact that the company tried to do it at all, distracting from its core business.
Okay, moving to Category 2. We're looking at clean tech and solar, which faces the risk of relative rotation.
This is a classic zero-sum risk based on a conflict of narratives. If investor attention is being intentionally directed toward defense plus energy security, which celebrates traditional established fossil fuel infrastructure,
then some of that capital is likely to come out of sectors with competing narratives.
Exactly.
And clean tech and solar names are often seen as being very dependent on government policy and long-term growth forecasts, which makes them more sensitive than, say, an established oil major.
Much more sensitive. This sector has higher growth ambitions, which often means debt-heavy balance sheets, and they are acutely sensitive to the political climate.
That makes them high beta. Their stock prices move more dramatically than the overall market.
They do. So the launch of ETFs promoting energy security, which is often interpreted as conventional energy, gives capital a legitimate reason to exit the higher-risk, policy-dependent clean tech space.
And move toward the stability of the big energy majors like ExxonMobil and Chevron.
It's a rotation seeking stability and immediate profitability over that future growth potential.
So let's name the specific companies that are cited as being most at risk of this rotation.
We are looking at Enphase Energy, ticker ENPH, for solar, FSLR, and NextEra Energy, NEE.
Okay, Enphase.
ENPH is known for residential solar components, so they're highly sensitive to interest rates and consumer spending. First Solar, FSLR, is a big panel manufacturer whose margins can be sensitive to global commodity prices.
And NextEra Energy, it's a huge utility.
It is, but NEE has extensive exposure to renewables and is often seen as a bellwether for the clean energy transition. So if thematic flows start to emphasize traditional energy, these clean tech giants could face relative underperformance as investors reallocate.
All right, finally, let's look at category 3, coastal office and urban-centric REITs. They're facing relative underperformance risk. This is the direct counterpoint to the red state real estate theme.
Yes, the framing of the red state real estate theme acts as a narrative amplifier for a problem that already exists. It strengthens market preference that favors Sunbelt residential and industrial real estate.
Over REITs focused on slower growth, office-heavy properties in major coastal cities like New York and Boston. So basically, if money is actively flowing into single-family rentals in Phoenix and apartments in Tampa, it's often being pulled away from struggling, low-occupancy office buildings in cities where remote work has had the biggest impact.
That's the dynamic. The new ETF provides external validation that investors should prioritize these high-growth, demographically favorable residential regions. This creates pressure and underperformance risk for companies whose portfolios are concentrated in coastal, office-centric properties.
They're still dealing with post-pandemic occupancy issues, high refinancing risks.
And just structural changes in how we work. They are competing for capital against a narrative that is explicitly anti-urban core.
Which specific tickers are highlighted as being at risk here because of their portfolios?
We need to watch Boston Properties, ticker BXP, Vornado Realty Trust, VNO, and SL Green, SLG.
And these are all big players in office real estate in major coastal cities.
They are high-profile REITs with extensive exposure to large, often premium office towers. Because the new ETFs theme is so specific geographically and by asset type, these office-centric REITs find themselves on the wrong side of the thematic rotation,
Leading to persistent relative underperformance compared to their Sunbelt residential peers.
Correct.
So let's synthesize this whole market map. What's the net takeaway?
The net takeaway is not about the issuer, DJT, or the absolute dollar value of the new funds. The ETFs themselves probably don't have the capacity to move the whole market initially. Their AUM will likely be limited to start, but the introduction of these specific, highly branded themes serves as a catalyst. It can influence investment flows at the margin. It defines which established sectors, defense, conventional energy, and Sunbelt residential real estate, are currently favored by a specific political and economic narrative.
And the recommendation for observation is consistent. Follow the capital flow, not just the headlines about the issuer.
Exactly. We continue to keep a close eye on Lockheed Martin, LMT, ExxonMobil, XOM, and those selected Sunbelt REITs for any signs of strength that could be driven by this thematic focus.
And on the other side?
On the other side, Trump Media, DJT, is established as a vehicle characterized by high volatility. Its movements will be driven primarily by market confidence in the company's ability to execute this broad new strategy. That stock will likely remain highly news-dependent and susceptible to those strategy dilution risks.
It's really something to see how specific this market targeting has become. We've gone from broad sector ETFs to funds that are explicitly branded by geography and politics. It makes for a compelling trade watch, seeing how narrative finance translates into capital allocation across such different sectors.
From fighter jets to rental homes.
Right. So here's a final concept for you, the listener, to think about. Consider how the market's specific preference for geo-specific real estate, focusing so intensely on the Sun Belt, might affect investment in reloaded sectors that serve those same areas. Think about regional banking institutions or infrastructure development companies that have a major footprint in those high-growth Sun Belt regions. The thematic focus can often bleed over into adjacent industries, creating secondary opportunities or risks. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.